This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Happy New Year and welcome back to your TF Metals Report podcast highlights. It's a free service, something we try to do every single week, give you some idea of what we're talking about at TF Metals Report. But of course, it's just a small sample of our daily podcasts and some of our daily writings. If you really want to get the full money, you got to join the site, and it's only $15 a month. I mean, it's less than a magazine subscription and far more valuable. As the new year began on Tuesday, January the 2nd, we started to get some of the trade that I was expecting as we came out of 2023. Rate cut expectations had gotten way ahead of themselves. There was a 95% chance of a rate cut in March as we ended 2023. That was way off. That number should not be more than 50-50. I mean, who knows what the world's going to look like by the middle of March, right? So anyway, we knew that rate cut expectations had to come in a little bit. And as the new year began, that's exactly what happened. And as that happened, the dollar index rallied sharply. Now, is that it? Will the dollar index just simply bear flag again like it has done all the way down from October and then make an even lower low below 101? Now, that'll be a key to how the markets trade here in January. We'll have to see. And that was all part of what we discussed as the new year began on January 2nd. Where does the dollar head from here? This is going to be the most important chart of the week. Okay, we've been tracking all these bear flags all the way down from 107. 101 was my target. We got there on Wednesday and then immediately reversed and now surging today. If we get above, you could say 102.50, that would make me kind of nervous, but we'd really have to get all the way up above 103 before I thought, that low's in and we're going to 104 and basing in the dollar. There is still a chance, and again, this will be data driven later this week, that this is just another bear flag. Okay, you can see them all on here. Bounce from 101 and the ultimate destination is all the way down here, these lows of July last year. If that's the case, and the dollar index is going to fall from here we are north of 102 to sub 100. That's 2.5 points. We're going to get a pretty good bounce. We're going to get above 2100 in February gold. What's more likely in my mind is that's not the case. And we are going to kind of stretch out a little bit of a bounce here in the dollar. We're going to dial back some of the rate hike expectations as we go through this month. And we're going to sit there and start pulling back instead. With the dollar index continuing to rally on Wednesday the 3rd, we got a pretty sharp plunge in COMEX gold that day, about $30 down. Again, this is to be expected as those rate cut expectations come in a little bit. There have been several times now, and you'll recall this chart from previous podcast summaries, several times where price has gotten above the 50-day moving average in COMEX gold and then pulled back to the 50-day support. It happened in the middle of November. It happened in the middle of December, and it looks pegged now to happen in the middle of January as well. If the support holds, we'll look for another rally to come off of the bounce. But for now, we're waiting for that pullback to that support. Will we get all the way down to the 50-day? It's all part of what we discussed on Wednesday, January the 3rd. Here's your chart on COMEX gold. We talked about this yesterday. Getting back above the 50-day moving average in the middle of October. Rallying $100. Coming back down to the 50-day in the middle of November. Rallying $130. Coming back down to the 50-day in the middle of December. Rallying $110. And now heading back down again toward that 50-day. Now that 50-day is down here $20.27, so it's a full 20 some odd dollars down from here. But if the data is somehow strong tomorrow, or particularly on Friday, we could still get there as we get into the next week and the CPI and everything else. For now, though, the trend still looks fine. Not as beautiful as it was 4 days ago. And again, 4 days ago, we talked about how strong this chart looked when we were up here at 2095. But we were always worried about a potential double top being painted. And that's now where we stand. Again, as we begin the new year in 2024, it's all about rate cut expectations that have gotten too far ahead of themselves. What the Fed is projecting 3, but the market was projecting as many as 8 in late December with consensus at about 6. I think that's too many, at least for what we know as the year begins. Should be more like 4. So as those expectations adjust, some of the bids, some of the excitement for not only gold and silver and the mining shares, but the market in general starts to come back out. The good news is, as that has been adjusting, yeah, gold's down, but it's only down maybe $20 so far. And as we discussed back on Wednesday, probably just simply has a date with its 50-day moving average. But you need to understand this stuff about rate cut expectations and how it's going to impact things here in January and probably into February too. And that's all part of what we discussed on Thursday the 4th. Because really what you're seeing is just a reaction to rate cut expectations changing. You can see that in the third image. As we began the year, this thing from Jim Bianco draws it out nicely. See the blue line? That's where we were at the end of the year, pricing in maybe 6 rate cuts, maybe 7, maybe 8, but the consensus was 6. Today, that's down to 5. That's the red line. And again, the Fed is up here by the dot plot showing 3. All right, so really, this red line needs to come up here more to 4, not 5, to be kind of neutral, as I was saying earlier. Okay, but this shift from where we were at the end of last week to where we are now, that's why the stock market's down. That's why gold's down. That's why the dollar is up. Okay, and it's going to shift again tomorrow. And on Friday, January the 5th, the first week of the year concludes with the first BLS of the year, the U.S. jobs report for the month of December. And oh boy, man, if you don't understand how politically motivated all of this .gov data is at this point, then you're living in ostrich land with your head firmly entrenched in the sand. What is it? Something like 95% of all the government bureaucrats that live in the D.C. and Northern Virginia area are registered Democrats, and the numbers are being cooked as we enter the election year. We now have had 10 of the 11 months of 2023 jobs data revised sharply lower. So a headline number gets cranked out, only to be revised a month later when nobody pays attention. You get the market reaction and the political talking points on the headlines, and then it's revised lower later. The December report, particularly egregious. I strongly urge you to do your own research. Don't just take what the MSM is shoveling and take it as truth. Do your own research. In December, part-time jobs rose by 762,000, with full-time jobs down 1.5 million. However, that's at the household level. You call people up, ask them how it's going. At the establishment level, you do all the massaging, the birth-death adjustment, everything else, and you come up with 218,000 new jobs added. Again, as it has been all year, that number will be revised lower. And in any event, what is happening is that people are losing their good-paying, full-time jobs with benefits and PTO, and they're desperately trying to replace that income with part-time jobs. You lose one job, you replace it with 3, and the Bureau of Labor Statistics counts that as a net gain of 2 jobs. It's a scam. It is a lie. It is what Jim Sinclair used to call spin and mope management of perceptions. So please, I urge you, take some time to educate yourself this weekend. And if you don't already know, educate yourself about what a scam the markets are as well. Oh yeah, fundamentals matter, right? As you can see on today's only chart, look at the intraday action in the dollar index versus COMEX digital gold. On the news, the initial reaction was a spike in the dollar index and a plunge in COMEX gold. These are 1-minute charts. But then, as this news was dissected and people figured out what a scam it was, the dollar began to fall. Then at 10 o'clock Eastern, the latest service sector PMI numbers came out and the dollar plunged even further. The lows of the day in the dollar were made shortly thereafter. The highs of the day in gold were made. And then everything turned around again. And now everything is basically back to unchanged. The only people making money in these markets are the banks. Understand that. And if anything betrays that fundamentals do not matter, it's all computer driven, just look at these 2 charts. Perfect mirror images. All right, that's it for this week. Please come back next week. You're going to want to keep an eye on TF Metals Report. We always put out our macro cast, our annual forecast for the year ahead, sometime in early January. Right now I'm targeting Monday the 8th, maybe Tuesday the 9th for getting that all wrapped up. It'll be a free report. You'll be able to find it on my Twitter feed at TF Metals. You'll also be able to find it at Sprott Money, or just come to my site, tfmetalsreport.com. Again, it will be a free post. I invite you to read it, give you some idea at least of what I'm thinking about the year ahead. Thank you for listening to this week's TF Metals Report podcast highlights. Of course, we invite you to join TF Metals Report. No time like the present to do it. It's only $15 a month, which works out to what, 50 cents a day? Come join us. It's money well spent. And it's a time like this, with as crazy as everything is in 2024, the site is just simply invaluable. Not just for what I do, but for the community. Again, give us a try. It's just $15 a month. tfmetalsreport.com. Thanks for listening. Have a great weekend.